Guys, it's Doc's Market Minute for Monday, October 26th. I'm looking at the Russell 2000 right now. And the Russell 2000 actually is not in that great a shape. It has not seen the rebound off the bottom like the other indices have. And I think this is partly due to the fact that the Russell tends to be a canary in the coal mine for the fund managers, especially around this time of year, where they get a little bit conservative, and the Russell index has just not been doing that well lately. So for a lot of reasons, they've been shifting their funds into large caps, trying to be able to beat the S&P 500. Since the S&P just went positive for the year, these guys are holding their nose in a chase for performance. So the Russell's been getting ignored to this point, but that doesn't mean that it can't catch up at some point here pretty soon. And what I like about this is I see a little ascending triangle pattern setting up on the Russell here. So this is equal highs but higher lows on this, and this builds up a lot of pressure. So we can see all this energy here, and at some point it's going to burst out of here, and it might make an expected move trade. So let's look over at the option chain and see if we can design an expected move trade which will allow us to make a really nice profit for a small investment. So let's see if we can design one for that. Okay, so let's bring up the broker interface. Let's go over to the chain here, and for the Russell, let's use the IWM because that is 1/10 the size of the true Russell, and so we can trade these positions with much smaller accounts. Now the next thing we need to figure out is how long do we need for this move. And let's just say the move is going to occur at some point here in the next 3 weeks or so. Now, if we look at the November options, we're seeing that an expected move is about 4.6 points from current prices. Now, what an expected move is basically saying is that from today's current price, it's saying that there's a 68% chance of the price being in an envelope bounded by plus 4.6 and minus 4.6. So it's going to be somewhere about in that 9-point window here. There's a 68% chance that it's going to be there. But based on the chart pattern that we're seeing, which is this sort of ascending triangle, we're going to give the edge to the upside in the short run. So what we're going to do is we're going to look at the current price, which is going to, let's just say it's about $1.15 here, and we're going to add 4.6 onto that. And so we get a target that's between 119 and 120. So let's look at that. The 119-120 call spread for November. And if we go in here and if we buy a vertical, so we're going to buy this vertical instead. So 119, and we'll go out to the 120 just to keep things simple here. And we can see that's going to be about 20 cents. That's very common for a trade like this to be 20 cents. So that's $20 per contract. Just about any account can trade this as long as you can trade a vertical spread. The most that you can lose on this trade is your investment into this, which is 20 cents or $20 per contract. So this is a great technique for smaller accounts to be able to participate in fairly big moves for a very small cost. So if we were to try to play this along with a call option, a standard call option, let's go back to the chain here and look at that. A standard call option, typically what we're looking for is maybe something like a 70 delta. Let's bring up this part of the chain. So we're going to look for about a 70 delta option, and that's going to be somewhere on the order of 420 or so dollars per contract, 420 debit for this. So that is usually a pretty significant chunk of capital for most small accounts, and this is one reason why most small accounts with options do get blown out, because we're using the wrong strategy. So using long calls with a small account to me is a recipe for eventual erosion of that account capital, because it's the easiest trade to be able to enter, and it's the most very difficult trade to be able to get a consistent profit with, is that long call. But if you're setting up call spreads out of the money at 20 bucks per contract, the key here is that you're not risking very much, and you're getting about a 4 to 5 to 1 reward to risk on that trade is potential. So that's it for today's Market Minute. Hope that helps. We'll see you tomorrow.